Okay, hi everyone. This is going to be the lecture for the problems on chapter one. Now, essentially with the problems, what we will do, we will start with a series of multiple choice problems. That way, on the exam or if it's in homework, you'll see this tested in that capacity. Thereafter, we will switch into and complete some problems together that are more like writing it out and working through it together. Now, if we were to go through and look at these, right, so we have usually about 10 multiple choice questions we do. So we have like 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So let's work our way through these, okay? The first one, if we read it here, it says, which of the following is not one of the four financial statements? In this case, right, we know the four financial statements are the balance sheet, the income statement, the statement of owner's equity, and the statement of cash flows. For that reason, this answer is going to be B, right, for one, the audit report. What is the audit report? That's essentially a report an auditor issues about the fairness of the financial statements produced by a company. Speaking of the audit report, right? So we have a company who hires an auditor to audit their financial statements. That auditor produces an audit report. It's not a financial statement, it's a separate item. When we're talking about that, the primary responsibility of the company's financial statements, they lie with, this is going to be, 2 is going to be D, right? Management. So when we say management, we mean like the CEO, the CFO, top individuals in the firm. If you recall, we said with Enron, when that happened, the Enron was pointing their fingers at Arthur Andersen, the CPA firm, and Arthur Andersen was pointing the finger back at Enron, saying like, you're responsible. After that, the federal government came along and they said, hey, you know what, management, you're ultimately responsible. So if people, like the CEO, if they sign off on those financial statements and then there's issues on them, that CEO could potentially go to jail. Number 3 here, let's look at it. It says, which of the following is true? So for 3, this is going to be D, right? FASB makes GAAP. It's like the NFL makes the rule book. FASB makes GAAP. Let's look at 4 here. It says, which of the following regarding retained earnings is false? So 4, the answer here is going to be C. Retained earnings is an asset on the balance sheet. Now, if we were to look at the balance sheet, right, it's our assets equal our liabilities plus our stockholders' equity. Then we said our stockholders' equity is broken out between common stock and retained earnings. Right, if I were to draw a little arrow in here. Right, so it's not an asset on the balance sheet. It's part of stockholders' equity. That's where you're going to see retained earnings. And if we look at the other answers here, it says retained earnings is increased by net income and decreased by a loss. Well, that's true, right? If you remember that like baby formula for retained earnings, it says that. B here, it says retained earnings is part of stockholders' equity on the balance sheet. Well, that's true. We just showed that over on the side there. And then D, it says retained earnings represent earnings not distributed to stockholders in the form of a dividend. Well, that's true. We said retained earnings are those earnings you keep within the business after you pay dividends. Let's look here at 5, right? 5 says, which of the following is not one of the 4 items that would be shown on a financial statement? This one's going to be A for 5. You're not going to put the preparer's name on the financial statements. That is to say, when we're talking about accounting, we're very objective. We're just reporting the information. We're not really getting into like what individual prepared these. They're represented by the company as a whole, in full, I mean to say. And, the CEO, the CFO, they sign off on them. So not going to see that. But you would see like the type of financial statement, what measurement unit they're using, dollars, the name of the business, so on and so forth. 6, it says, which of the following regarding the statement of cash flows is true? Okay, so if we look at A, it says the statement of cash flows breaks it into 3 categories: operating, investing, and financing. We know that's true. B here, it says the ending cash balance on the statement of cash flows agrees with the amount shown on the balance sheet for the same fiscal period. That's true. What does that mean, right? One of the things we're going to be seeing here in this lecture is like the interrelationship of the financial statements. So if you have the statement of cash flows, your beginning cash plus your inflows minus your outflows gives you your ending cash. If you were to then go look on the balance sheet, you have your assets, your liabilities, and your stockholders' equity, and you start to list out the accounts, what this is saying is the ending cash from the statement of cash flows, that's the cash that you see on your balance sheet. And there's other items like that that flow between the financial statements. When we do the last problem, problem 1.1, we'll look at that and see. 7 says, which of the following is not a type of note you would see in the annual report? So the annual report's like the end of the year financial statements. This one's going to be A. So if A is false, let's look at the other ones to see why they're true. So we said the footnotes, right? Those are basically descriptive detail and provide more information about the financial statement. So with that being said, right, you might have one that's providing more detail. You might have one that talks about the accounting rules. You might have one that talks about the disclosures. What you wouldn't have is a note about the auditor's opinion about the performance of the business. In other words, auditors are separate from the company. Anything they do is going to be in the audit report. It's not going to be like in the financial statements per se. And generally, auditors, again, are very objective. They're looking at, the business for the financial statements for fairness. They're not really, providing qualitative analysis like you should invest in this company or not. These are separate items here, separate things. 8 here says, which of the following is true regarding income statements? So 8, this is going to be A here for 8. The income statement is sometimes called the statement of operations. So with all of the financial statements, how we study them, right, the balance sheet, the income statement, we use, and I try to use the consistent terminology. In practice or in other parts of the world or different industries, they might mean the same thing but have a different name for it. So sometimes the income statement is called the P&L, the profit and loss. Sometimes it's called the statement of operations. It's like the balance sheet. Sometimes it's called the statement of financial position. All means the same thing, just a different term for it. So if that's true, why are these false? Right? It says the income statement has revenues, expenses, and liabilities. Well, that's false. Yes, we do have revenues and expenses, but we don't have liabilities. Those are on the balance sheet. Then it says the income statement reports revenue for which cash was received at a point of sale. That's false, right? One of the things we'll learn about is cash basis versus accrual basis. This is a later chapter topic, but I'm just kind of planting the seed right now. One thing that comes from and what we're using, and which GAAP says, is you have to use the accrual basis. Under the accrual basis, cash in does not necessarily mean revenue. Likewise, the cash out does not necessarily mean expense. So if you have an inflow of cash or an outflow, it can, but it doesn't mean that it's revenue or expense, respectively. So for right now, just plant that seed in your head. We'll talk about what it means in a later chapter. D here, it says the income statement reports the financial position of a business at a point in time. That's false, right? That's the balance sheet. The balance sheet is at a point in time. The income statement is for a period of time. 9, it says, which of the following is false regarding the balance sheet? Okay, so this one's going to be C. This one, it says C says the balance sheet reports changes in the account balance over a period of time. No, that's false. We just said that, right? The balance sheet is at a point in time. It's like a snapshot. Where do you stand right now whenever we show this? And so if that's the case, the other 3 must be true, right? So the first one says the balance sheet shows the accounting equation. That's true. Assets equal liabilities plus stockholders' equity. The next one says retained earnings on the balance sheet agrees with or matches ending retained earnings on the statement of owner's equity. That's true. We'll talk about that, right? The interrelationship of the financial statements. And D here is basically defining the balance sheet, right? It has assets, liabilities, and stockholders' equity at a point in time. Finally here, 10, it says, which of the following regarding GAAP is true? This one's going to be B. Changes in GAAP can affect the interests of managers and stockholders. So, hey, if they start playing around with the accounting rules, stockholders and managers, they're going to care. It's going to affect them. If that's true, let's talk about the other ones, why they're false, right? So U.S. GAAP is a body of accounting knowledge followed by all countries in the world. No, that's false. Remember we said, a lot of the other parts of the world use IFRS. It's like the metric system. GAAP is an abbreviation for generally accepted auditing procedures. C, that's false. It means generally accepted accounting principles, not auditing procedures. And then D here says changes to GAAP have to be approved by the Senate. No, that's not the case. Changes to GAAP are made by the FASB, not by the Senate. So let's look through here. If we have time, or depending on where we land, we'll go through. I always build in an extra problem or two just to see where we're at with how much time. And I'd rather have more than not have enough. So if there's enough time and we want to come back to it, we'll do this E11 here. But let's do E15 first. So that means like exercise 1.5 if you purchase the book. What they're doing here, if we look at this, right, they want us to prepare a balance sheet. Okay, so we have some facts here. Okay, so it looks like Bennett Griffin and Chula Garza organized a bookstore as a corporation. Each contributed $80,000 to start the business and received common stock. So we have 2 people started a business, each contributed $80K for stock. So this means, right, if each 2 people put $80K in, that there's $160K of common stock. Okay? Then it said the store completed its first year of operations on December 31st. Okay, so this is the first year of operations. Why do we care about that? This means beginning retained earnings is $0. In other words, if you just started the business, right, you don't have any previous earnings that are there that you earned. You just started it. It's like if you opened up a bank account, right, and I said, well, what was your cash balance in there 2 days ago? You say, oh, I didn't put any cash in there yet. I didn't even have the bank account. It's like the same in the very first year that you start a business. The beginning retained earnings is 0. Every other year thereafter, that is to say, other than the first year, your beginning retained earnings are the prior year's ending retained earnings. We'll learn about that in a subsequent example. Just planting the seed. Last year's ending is this year's beginning. We'll look at that. But then it goes on to say, right, it gives us some account balances at year end, right? So we know common stock is 160,000. We get that. Then they're going through and they're giving us a bunch of them. And if we look at it here, it looks like they had cash, right, of 75,600. They had amounts due from customers for the sales of books, right? So that's going to be an account receivable. Remember, I said receivables are assets, payables are liabilities. So receivables, that's like when you have a transaction and then the person's going to pay you later on, right? We talked about room service, right? If you were to order room service and you say, just put it on my account, right? You get the room service and then you pay the $50 the next day. Right after you get the room service, right, you have something called an account payable. Payable is a liability. You owe that $50. From the hotel's point of view, they have a receivable, right? You owe them $50. It's an asset to them. So we have receivables that are assets, payables that are liabilities. We also distinguish between an account receivable and a note receivable, or payable, right? The idea between an account and a note. What's the difference? An account receivable or payable does not accrue interest. In other words, if you borrowed or you got that room service for $50, you'd have to pay back just the $50. In distinction, right, if you borrowed money under a note, the bank would have a note receivable and you would have a note payable. And say that you borrowed, $1,000. In that case, you'd pay back the $1,000 as well as you would pay interest on top of that, maybe like $100, $200, whatever the terms and conditions of the note are. But that's the distinction between account receivable, account payable, note receivable, note payable. If it's a receivable, it's an asset. If it's payable, it's a liability. Accounts are less formal. They don't accrue interest. Notes are more formal. You have like a written contract, and they do accrue interest. Continuing here, it looks like we have some equipment, right, of how much there? Let's see, 73,000. Looks like we then have an account payable. We owe someone money. It looks like we got some books and then we're going to pay them later, right? $12,000. And then we have a note payable to a bank. We borrowed some money for $3,000. A couple other things here. Be aware of this down here. 2 other facts we have to add to this scenario. So whenever they wrote this, they put this in another area of the book. I'm going to just put it right here so we can be aware of it. So this right here is part of the scenario where I'm getting this information. It looks like there was interest payable of $300, and then it looks like the net income for the year was $12,300. Now that's the answer for it, right? Let's just assume instead that retained earnings was $12,300. You could do either one here. It's not that big of a deal. But and the final point here is there were no dividends paid or declared. This last little line, right? So that was kind of a mouthful with all of this. This is what's going on. The facts from the books. This is kind of a summarized view. of it. So if we were to go through and classify these, right, it could really, we're preparing a balance sheet here. It could be one of three things, right? It could be an asset, a liability, or a stockholder's equity account. Common stock is stockholder's equity. Cash is an asset. The receivables are asset. Equipment's an asset. Remember we said payables are liabilities. Retained earnings is a stockholder's equity account. So let's go through then after we classified them there and start to break this out. Okay, under our assets, right? And what we're going to do is we're just going to snag them from over here. So let's make these all red to show where we're getting them from, right? We have our cash, our AR, our account receivable, and we have our equipment. Okay. I'm going to get the cash. I'm going to get the account receivable. I'm going to get the equipment. And then down here, we're going to have our total assets, which is the sum of those three, 187,600. Next, we have our liabilities, right? These are going to be these guys right here. So it's going to be, right, our account payable, in this case, our note payable, and then we have our interest payable. So that's going to be 3,300. Right, so our total liabilities then are going to be the sum of these guys. And then for our stockholders' equity, we have our common stock and our retained earnings. Right there. Just going to give us our total stockholders' equity, which equals these two combined. So 172,200. Then down here at the bottom, we would have our total liabilities plus our stockholders' equity. In other words, it would be this plus that. Right, so you can see here, this would be, the functional equivalent of our balance sheet, right? We'd have our assets, our liabilities, our stockholders' equity. We went through, we listed them out, we classified them, and we just plugged them in over here. And again, where did we get this number from? It's that plus that. Now, one of the things down here, the second question says, what amount was net income, right? So the second part is, what is net income for the year? So this is a little tricky, right? Because they're not giving you any revenues or expenses. How do you figure this out? Well, in this case, you're going to have to phone a friend. I mean to say, look at another financial statement. In other words, what we could do here, if we want to know what net income is, we don't have revenues or expenses, but we do have other items. So we could use the retained earnings equation to solve for this, right? Like beginning retained earnings plus your net income minus your dividends equals your ending retained earnings. So in this case, right, our ending retained earnings, we're going to snag right from the balance sheet, right? This goes to like how they're interrelated with each other. We know as well, if we go back at the facts, because this was the first year of operations, our beginning retained earnings is 0. We also know we didn't declare dividends. That's 0. So that means this has to be 12,300. In other words, 0 plus 12,300 minus 0 equals 12,300. So you see how that's a little bit tricky there. They're not giving it to you explicitly. You have to kind of back into it. Okay, continuing here then, right? Let's move on to E17, the next problem. So here it looks like they're giving us some information, and then they want us to prepare an income statement, right? So they want us to prepare an income statement. So our revenues minus our expenses equal our net income or net loss. Now it looks like they're giving us some accounts here, so let's list these out, right? We have our cost of sales. This is going to be 44,814. We have our income taxes of 371. We have our interest expense of 303. We have our net income or net earnings here of 1395. We have our sales of 55,371. We have our earnings before income taxes of 1766. So EBIT, earnings before income taxes. Then we're going to have our SG&A expense, our selling, our general and administrative expense of 8504. We're going to have our other revenues of 16. Then we'll have total expenses without income tax. So before we take the income tax expense, that's going to be 53,621. Then we're going to have total revenues of 55,387. Okay, so let's, like with the balance sheet, go through and classify these items. So give me a second here. Let me see. There we go. So really, when you're classifying the income statement, it can be one of three things. It can be a revenue, it can be an expense, or it can be a subtotal line, or like a total line. So a lot of times in the income statement, just to preface this, it's your revenues minus your expenses. However, as you go through, they say, stop, show me your total revenues. Stop, show me your total expenses. Stop, show me your income before you pay taxes. Stop, show me your net income after you pay taxes. So here, cost of sales. Remember we said that cost of sales and cost of goods sold is an expense. We'll learn about in the income statement chapter what that means. But for the time being, just be aware, cost of goods sold, cost of sales is an expense. Income taxes are an expense. Interest expense is an expense. Your net income, right, is your net income. Your sales is a revenue. Your EBIT, your earnings before taxes, are going to be a subtotal. Your SG&A is an expense. Your other revenue is a revenue. And then your total expenses without income taxes and your total revenues are subtotals. Okay, let's build this out here, right? We're going to start with our revenues. So we have our sales, right, of 55,371. Then we have our other revenues of 16, right? So that's going to then get us our total revenues of 55,387. In other words, we're going to do a little stop sign there, right? This plus that equals your total revenues. Next, let's look at our expenses, right? So, okay, we use that, we use that, we use that. So here with our expenses, like I said, generally when you're doing the income statement, you're going to want to use your cost of sales or your cost of goods sold as your first expense. And then your last expense are going to be your income taxes. So here we have cost of sales, right, which is an expense, $44,000. Then we're going to have our SG&A expense of, let's see here, $8,504. We're going to have our interest expense right here of $303. And that's going to give us our total expenses here, right? Before income taxes, so these are all our expenses without income tax expense of, let's see here, we could just sum these. 53,621, right? So it ties out right over here. So we use that, we use that, we didn't use that. Now what we do is we're going to have our earnings before taxes, right? It's going to be this 1766 right here. What that means, what you're doing is you're taking the 55, your total revenue, minus your expenses, except for your tax expense, to get you at 1766. Thereafter, you back out your tax expense, right, your income taxes, 371, and then that's going to get you your net income of 1395. So in other words, you have your revenues minus all of your expenses, get you your net income right here. But when you do it, right, it's like stop, show me your total revenues. Stop, show me your total expenses. Stop, show me your earnings before taxes. Stop, show me your earnings after taxes. This is kind of like, imagine that you made $20 an hour and you worked 5 hours, right? So this is like your gross pay, right? Your total pay. However, when you get your paycheck, right, maybe you only get a paycheck for $70, right? The idea here is, in that case, you would have had 30 of taxes. In the same way, right, with businesses, we want to see your earnings before taxes, and we want to see them after taxes. That's the setup with it. Let's look here at E113. Okay, so they're giving us some information here. It looks like a company was organized January 1st, 2022. So first year of operations is year 1, and then has 2 years of operations they're showing here. They want us to prepare a year 2 statement of stockholders' equity. Okay, so we have year 1, which was 2022, right? Move that over. And then we have year 2, which was 2023. Make that yellow. I'll make that blue, just to distinguish here. Then they give us some information about it, right? So like our net income, looks like it was 31,000, and then 42,000. Looks like our dividends here were 14,200, and then 18,700. And we had our total assets of 130 and 250. And then we had our common stock at the end of the year. So I'll just put common stock at year end of 100 and 100. And then let me add some commas to these guys right here just so we can read them better. Okay, so what's going on here? They say, hey, for year 2, 2023, right? So for this year, can you please prepare a statement of owner's equity? Now we know the statement of owner's equity has 2 components, a common stock component and a retained earnings component, each having their own kind of baby equation, right? It's your beginning common stock plus any common stock you sold minus any common stock you bought back gives you your ending common stock, right? And then for retained earnings, it's your beginning retained earnings plus your net income or minus your net loss minus any dividends equals your ending retained earnings. Okay? So first off, we're doing this over here, this statement of owner's equity or stockholders' equity. Shift that down. We're doing it for the end of the year on 2023, right? So we're focusing on this guy right here, at least in theory. So some of these things we can just nab right from over here, right? Like the ending common stock, get it right there. Let's see what else they give us. Looks like our net income we can get right from over here. Let's see what else. Oh, I'm sorry, that was dividends. 42,000. Oh, they give us dividends as well, 18,700. And then let's see what else here. Sold, bought back. Okay, now we're in a little bit of a bind here. We have to start thinking about things. This is just what's given that we can plug in here. So let's go back and let's talk a little bit about, here's an idea with accounting. Here's the idea. Last year's ending is this year's beginning. What does that mean, right? So imagine we're at a New Year's Eve party, right? And it's 11:59 at night, and I ask you to open up your wallet. And I say, how much cash do you have in there? And you would say, okay, you pull out 220s. You say, hey, I got $40. All right, then the midnight, it's the clock strikes 12, and everybody's celebrating. And at 12:01, I come up to you and I say, hey, how much cash do you have? And you say, hey, I just told you I have $40. That's kind of the idea with accounting, right? Last year's ending balance is this year's beginning. So if you have $40 at the end of last year, then you have $40 at the beginning of this year. So last year's ending balance is this year's beginning balance. So that means last year, at the end of 2022, the balance for common stock has to be this year's beginning balance. And if that's the case, right, then these two have to be zero. In other words, for the equation to work, if it's 100,000, plus 0 minus 0, it equals ending common stock. We must not have sold any during the year. Likewise, if we're looking at retained earnings here, right, for 2023, we don't have beginning retained earnings. However, we can use this idea, right, last year's ending is this year's beginning, to help us. In other words, what we're going to do here is we're going to phone a friend, not a different financial statement, but the same one for a different year. What does that mean? In other words, we're going to do a retained earnings for 2022. Let me get the highlighter here. Right, so we'd have the same setup, beginning plus net income minus dividends equals ending. Okay, so if we get this right here, right, if you think about it, last year's ending is this year's beginning, we can plug it in right up here and we'll be able to solve for ending retained earnings. So for 2022, our net income is 31,000. Our dividends are 14.2. And check it out, we set up here year 2022, year one. This was the first year of operation. So in the first year of operations, like in that first example we did, beginning retained earnings is 0. In other words, we didn't have any before. So in this case, our ending retained earnings would be our beginning plus our net income minus our net loss or minus our dividends equals 16,800. That flows right up into it, right? So then we can carry it over here, right? Beginning plus our net income minus our dividends equals our ending of 40,100. If we were then to be crazy, right, and like look at 2024, right, we made that orange and we were doing retained earnings, right? You'd have beginning plus net income minus dividends equals ending, right? Same setup. But in this case, our beginning in 2024 would be the 40,000, right? So like I said, only in the first year of operations is your beginning balance 0. Every other year, like 2024 or 2023, your beginning balance is last year's ending, right? The whole idea of this, of like last year's ending is this year's beginning, it's like that song Closing Time, right? If you know that song, there's a line in there that says something about like every new beginning comes from some other beginning's end, right? Closing Time's it's a good song, right? That's the idea, right? It's closing time. Last year's ending is this year's beginning. It all flows through that way. Finally here, right, we're going to do problem 1-1. I'll go through and I can give you the answers for these quickly at the end. But what they're doing here is they're giving us a bunch of information and they're saying, hey, can you please prepare an income statement, a statement of stockholders' equity, and a balance sheet. Okay, so if we go through here, I'm going to zoom in a little bit. We have all different types of accounts, right? We have cash for $25,600. We have an account receivable for $10,800. We have inventory of, let's see here, $81,000. And we have equipment for $42,000. We have an account payable, right, for $46,140. And then looks like we have a salary payable of $25,20. We have total revenue in this case of, let's see here, $128,400. Looks like we have total expenses other than income tax, right? That's that like stop sign. That's going to be, let's see here, $80,200. Then we have, income tax expense. This is a mystery number. And then we have common stock and dividends. So it looks like 87,000. Dividends of 10,000. So these are our like year-end balances, right, that are there. And let me put a okay, so and then it says down here, note the beginning balances of common stock and retained earnings are 0 because it's the first year of operations. All right, we just talked about that. So what did we do? We listed these out, right? Next, right, let's go through and classify them and talk about what financial statement they'd be on. So cash, it's an asset, right? It's on the balance sheet. Accounts receivable, an asset on the balance sheet. Inventory, an asset on the balance sheet. We have equipment, that's an asset on the balance sheet. We have an account payable. Remember we said payables are liabilities on the balance sheet. Salary payable, liability on the balance sheet. Total revenues, which are a revenue on the income statement. Total expenses, right, that's an expense on the income statement. Income tax expense is an expense on the income statement. And then we have common stock and dividends, which are stockholder equity accounts. And those relate to the statement of owner's equity and the balance sheet. Okay, so what we did is we just went through, we listed them out, right, what they're there, we classified them, we said what financial statement they're on. Let's start with an income statement, right? So in this case, right, we have our total revenues, right? So I'm just going to put total revenue of right here, 128,400, right? We also have our total expenses, and this is, you know, without income taxes. Remember, we have to break that out separately. So that's going to come from right here, the 80,200. And then I'm going to unbold these just to keep it simple here. That's going to get us, right, our EBIT, our earnings before income taxes. Sometimes this is called PTBI, pre-tax book income, right? This is like what you earned at your job versus your paycheck, right? What your actual take-home pay is. In between, you have taxes. So we have our PTBI here, our pre-tax book income of our total revenues minus our total expenses of 48,200. Then what we're going to do is we're going to back out our income taxes. But remember, this is the mystery, right? They don't really tell us much about it. However, if you go over here, they say income tax expense is 30%. In other words, there's a 30% tax rate. So what we do here for income taxes then is we take our earnings before taxes and we just multiply it times that tax rate, 30%, right? That means we're going to have roughly 14,000 in tax expense. So if we take our earnings before taxes, we back out our taxes. Earnings before taxes, take out the taxes. We have our earnings after taxes, right, or our net income, right? So our revenues minus our expenses equal our net income. Then we have, you know, some stop signs along the way. So I'm going to make this red, right? The next thing here, we're going to do a statement of owner's equity, right? Remember we said there's a common stock portion of it and a retained earnings portion of it. So in this case, right, the common stock, let me put another space in there, is going to be your beginning common stock plus what you sold minus what you bought back gives you your ending common stock. Likewise with retained earnings, right? It's your beginning retained earnings plus your net income minus your dividend gives you your ending retained earnings. Okay? All right, so here we go. Let's snag some of these numbers here. First off, if we go back, they said the beginning balances of common stock and retained earnings are 0. This is year 1, right? Cool, that's simple enough. We can just plug those in. It looks like over here, right, they're telling us that common stock has an $87,000 balance at the end of the year. So what that means is, if we started with 0 and we ended with 87, that means we had to have sold 87,000, right, for the equation to work. 0 plus 87 minus 0 ends with 87. I'm going to make that purple there. Likewise, for retained earnings, right, we have our beginning that was given to us. Looks like they told us 10,000 of dividends, but we're missing our net income, right? Oh, wait a second. Here it is up here, right? That's where we can snag it from, right? And that's kind of the point of this example, is to show you the interrelationship of the financial statements, right? So the net income from up here flows down to the net income on the statement of owner's equity. So in this case, it's going to be beginning plus your net income minus your dividends gives you your ending. So let's make that light blue, right? Then finally here, right, let's do the balance sheet. I'll just do BS, right? So we have our assets, we have our liabilities, right? We have our stockholder equity account. So our assets, we can just grab right from over here, right? We have cash, our accounts receivable, our inventory, our equipment, right? And what we would do is we would just snag these numbers right from over there. And then we could do total assets down here. Okay, 159,400, right? Next, let's look at our liabilities. So again, these ones we can snag right from over here, right? We have two different liabilities. It looks like we have accounts payable and we have salaries payable. So in this case, right, our total liabilities are going to be the combo of this plus that, 48,660. And then our stockholders' equity, remember we have common stock and retained earnings. But here's the deal with them, right? We get the amounts here right from up here, right? Common stock comes from there, and retained earnings comes from here, right? It's going to be the 87 and the 23, right? So I'm going to make that purple. I'm going to make that blue, right? So that's the answer here, but if you look at it, right, this is showing the interrelationship of the financial statement. You take the net income from the income statement down here, and you take the ending common stock and the ending retained earnings there, right? So if we totaled our stockholders' equity accounts, it's going to be the combo of those two. And then if we total our liabilities plus our stockholders' equity, right, that plus that, it's going to give us 159. In other words, our balance sheet balances. Our assets equal our liabilities plus our stockholders' equity. But check it out, right? Say that this answer, instead of being 33,000, somebody screwed it up, and somewhere up here they put 14, or let's just say they put 30,000 there, right, by accident. you could see that ripples through. That then changes here, which changes this, which changes this. And then, oh no, our balance sheet is out of balance. It doesn't balance anymore. So that's the idea with financial statements. They're all connected. If you screw up one of them, it's going to flow through to the others. So lastly here, we'll go through this. I can tell you it. One, the SEC. So if I were to just do like 1, 2, 3, 4, 5, 6, 7, 8. One here is going to be J, right? The SEC, that's the Securities and Exchange Commissions. 2 is going to be F, right? An audit is where you examine the financial reports to make sure that they conform with GAAP. 3, right? A sole proprietorship. This is going to be H. It's basically a single person business. 4 here is going to be E for a corporation. It's basically an incorporated entity. 5 is going to be A. Accounting is a system we use to collect financial information and report that. 6 is going to be D, right? Accounting entity. That means the organization for which financial data is to be collected. Basically, who are we doing this for? Who are we producing the financial statements for? 7 would be I. An audit report is a report that states the auditor's opinion. If we then look at 8, that's going to be L, publicly traded. That just means the company sells its stock to people who want to buy it on an open exchange. 9 here, partnership, that's going to be C. It's an unincorporated entity with 2 or more owners. 10 here, FASB, that's going to be K, right? It's the Financial Accounting Standards Board. They make GAAP, right? FASB makes GAAP. 11, CPA, this is going to be G. That means Certified Public Accountant. 12, relevant information. This is going to be B. It's basically information we use to help make decisions about the company, whether we want to invest or not. And then 13 here is going to be M in that case. In other words, GAAP is generally accepted accounting principles. So this is just a matching thing. Like I said, I put this in. I think it's important to look at accounting in different ways. Let's talk about it in the PowerPoint. Let's look at some multiple choice questions to see how it can be tested there. Let's go through some problems to show it, and then let's do some matching, right? And also throw in some class notes and some things about how this is done in the real world. So I do that as a mix of different things to expose you to accounting. It's definitely something that you're going to have to look at more than once, hear more than once. In other words, you're not going to be able to just read the PowerPoint once or listen to the lecture once and have this click. It's a combination of paying attention during class, completing the class notes, doing the optional problems, watching the videos, right? These videos are great because you can rewind them, right? If I was going a little fast for you, I go through at a reasonable pace, but I understand if you're taking notes or something, you're not going to be able to handwrite stuff as quickly as I'm going to be able to use it with a computer, right? A human is not going to beat a machine. So that's why, like I said, I think these videos are great. You can hear it over and over again. And then at the end, right, it all comes together. That way you'll be prepared for the exam. So to summarize this whole chapter, in 10, 20, 30 seconds here, we learned about the 4 financial statements, the equations for them, who makes the rules for accounting, how it's set up here in the U.S. versus everywhere else in the world. We then talked about what it means to be an accountant, different avenues and routes you can go. And then we rounded all of that off through examples and explanations, doing some multiple choice, doing some problems, doing some matching. So with all of that, I'm going to end chapter 1 here. Thank you very much, and I hope you enjoyed this and the rest of the chapters. We can all do well and be great accountants. So thank you again.